you've really been spoiling the markets of the last 10 quarters. You've always beat expectations, and then subsequently you were able to raise your guidance. You beat this time around, even though it was a very narrow beat, but you didn't quite manage to raise your guidance. Talk to us about what you saw this quarter and why you're a little more cautious than in previous quarters, maybe.
Well, I think this is the first time in many quarters where we've had some generic expiries hit us. You know, when you actually look at the underlying performance of the business, I think what's really exciting is our growth drivers all beat quite significantly. So on the one hand, we had Entresto, our large heart failure drug, go off patent. So that, I think, made us a little more cautious on the outlook for the remainder of the year. But Kisqali, our breast cancer medicine, beat significantly. Pluvicto, our prostate cancer medicine, beat significantly. Kesimpta, our multiple sclerosis medicine, beat. Scemblix, our cancer medicine, beat. So those beats are what matter, I think, that will really drive our growth going into 26 and beyond.
A loss of exclusivity is something that your company, the pharma sector overall, deals with all the time. This is a fact of life. However, where do we see the brunt of the erosion when it comes to the sales, when it comes to Entresto, which has been one of your blockbuster drugs?
Yeah, I think we'll see kind of the first full effect of Entresto in Q4. I mean, that's been the full quarter without Entresto exclusivity in the U.S. And we'll see those impacts going into Q1 and Q2 of next year. But as those growth drivers continue to perform really strongly, we'll come out of that, I think, coming back to that strong growth profile that investors have gotten used to. And I think that's what we're really focused on. Entresto is a fact of life in our industry. What really matters are those launches and also getting the next wave of pipeline assets into the registration and ultimately to launch.
The pipeline, a lot of catalysts are not until 2026. What should investors at this point in time be most excited about?
Well, we just got an approval of Rapsido, which is a drug for chronic spontaneous urticaria, a dermatological condition, which we think will be the first of many approvals for this medicine that could be a multi-billion-dollar asset that drives us into the next decade. Similarly, we're going to have the approval in prostate cancer of another indication for Pluvicto. That will be really exciting. And I think those two will be big drivers. And then actually later this week, we'll be announcing the full data set for the first medicine ever to show efficacy in Sjogren's disease, one of the most common conditions in rheumatology. That will be another important growth driver that we expect to get approval on next year. So 3 big approvals next year to then drive growth into the future.
So it seems as though you're pretty excited about what's to come, about what has been launched, and your ability to offset the generics competition, but still you felt the need to do a massive M&A deal. Over the weekend, $12 billion is something that you shelled out for Avidity in the US. That is your biggest deal in more than a decade. Talk to us about the rationale here.
Look, when I saw Avidity, I saw the opportunity, I think we saw the opportunity to bolster our neuromuscular pipeline. I mean, we really believe these are diseases that don't have approved medicines, they are debilitating conditions, and they affect, 50,000, 80,000, 100,000 patients depending on the geography, plus. And so the opportunity here to bring a first-in-class breakthrough medicines for 3 different diseases, 2 of which have multi-billion-dollar potential. This has really nothing to do with our near-term patent expiries. What I think this does is bolsters our growth profile 2030 to 2040. These are medicines that have patent protection to 2042, 2043. They're not susceptible to the US IRA, which gives us a big advantage there. And we have a huge footprint already in neuromuscular disease. So it was a great strategic fit, 3 late-stage assets, and so we're quite excited about the opportunity.
You've been super active when it comes to M&A. You've done, I believe, more than 35 deals over the last 12 months or so. Many of them, though, bolt-on, smaller than $5 billion a piece. Now, this one, obviously, that was the big one. Do you feel like you're done now?
Look, I think in our sector, we can never be done. We always have to look for great assets. But I think for us, it's all driven by the science and the technology. If it's a fit with our strategic areas of focus, if it's a fit with our technology areas, and in this case, neuroscience, RNA therapeutics, this was a perfect fit for us, then we'll, of course, keep doing the right deals. When you look at our free cash flow, I mean, it's approaching $20 billion a year. So we have adequate firepower to do deals like this to bolster the growth profile of the company.
When I last spoke to you, I believe end of January this year, you were pretty optimistic about a more permissive FTC. Was this one of the driving forces behind that continued deal-making flow?
Look, I think we, of course, are watching that, but in this case, this really wasn't a consideration, and there's really no overlaps here of note. I mean, I think this is really one where we felt like the strategic fit is what drove the deal.
Let's talk about the U.S. and let's talk about the tariff situation. To be honest, to be completely frank, I'm a little confused because everything is...
You're not the only one.
You're not? Okay, good. It's such a fluid situation. Now, recently, some of your competitors, Pfizer, AstraZeneca, struck a most favored nation deal with the White House. The analyst community is expecting for you to do the same. Can you tell us something?
We've been in conversations with the White House really since the beginning of this year, and we continue those conversations regularly. We're in touch on a weekly basis. We're, of course, looking to find a good solution to the challenges they've put forward. I think also importantly, we're also trying to tackle some of the bigger structural issues here. Pharmacy benefit managers, 340B, the fact that outside of the United States, innovation is not appropriately rewarded. So we're confident we'll come to an appropriate solution before the end of the year, but I think that's really right now something that's ongoing, and we'll hopefully be able to provide more updates soon.
But if you do strike a deal with the White House, that means the drug prices that you can charge in the U.S. are going to fall. In some cases, they might fall by 70, 80%. What is that going to do to profits, even if that means that you're shielded from tariffs?
I think really what's going to happen here is you're going to have fewer launches in public markets in the target countries outside of the United States. So I think prices in the U.S. will adjust, but they'll adjust modestly. I think really what you're going to have is a situation that unless overseas countries, these particularly as the administration is focused on the G7 plus Switzerland and Denmark, if they don't raise their prices up to reward innovation and on par with the U.S., companies won't launch in the public market in those countries. So really that's, I think, the administration's core goal is how do you get countries overseas to reward innovation and pay their fair share of the innovation ecosystem that the U.S. has historically been supporting. And that's how I think this will ultimately play out.
Do you think these G7 nations plus Switzerland, are they happy to raise prices? Not necessarily so.
I think this is going to be a challenge. It's going to take years to unfold. I think there's multiple elements to that. Of course, we want better rewarding of innovation. There's also a number of mechanisms like clawback mechanisms that claw back excess revenues. There's hidden taxes. I mean, I think all of these things will have to get addressed. But as you point out, it will not get addressed overnight. And this will be a multi-year effort to hopefully better have those countries better reflect the innovation that we bring.
Vas, while I have you here, now the White House also threatened 100% tariffs on branded pharmaceuticals unless new ground has been broken on U.S. facilities. I saw in a press release you spent investing $23 billion, and you're hoping to break ground on a number of facilities in the U.S. Does that also mean that you're shielded?
As best as we can understand, that as long as we continue to build our factories in the U.S. and we continue to work towards an appropriate agreement with the U.S., we can manage through the tariff situation. That's why we don't expect it to impact our near or midterm guidance. We have 5 facilities we'll break ground on before the end of this year. We'll be in a position, hopefully relatively soon, where we can produce our U.S. products for the U.S. And with respect to all the different tariff investigations, I've learned a lot about tariffs, I'd say, in the last 6 months. We're an industry that was never exposed to tariffs before, and now this has become a topic. But I think our teams have done a good job to navigate it. So we feel confident with where we are, and we'll just keep rolling with the various investigations.